Welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarry Ibrahim.
Thanks for listening to episode 123 of Thinking Like a Bank podcast. I recently had a conversation with a client who asked me, wouldn't it be better to just buy term and invest the rest in the stock market instead of a bank on yourself type whole life policy? He mentioned this may be cheaper in terms of fees and expenses and more profitable long term compared to just saving in a dividend paying whole life policy. I have been asked this question before, and it is a major concern when it comes to the idea of using bank on yourself. As a certified financial planner, I decided to use my skills to break this question down and use math and logic to come to a conclusion. This is something I recommend you do in any part of your life, especially if you're an entrepreneur. Use logic as much as possible to arrive at your decisions. If you know who Dr. K is on YouTube, he goes by the name Healthy Gamer. He talks a lot about psychology, neurology, and common mental hurdles people have, as well as cognitive errors. One of them being loss aversion bias. This is where you avoid the chance of loss as a defensive mechanism. In other words, your mind is trying to help you avoid loss by using mental calculations or mental accounting. This sounds cool, but it is emotionally based, and your mind usually uses inaccurate variables to arrive at an inaccurate conclusion. For example, one may ask, should I become a doctor? You may think of how much undergrad college is going to cost. Let's say $50,000 a year per year for 4 years. And then you might think, well, how much will grad school cost? Then you might think, well, it'll be $100,000 a year for 4 years in medical school. And then you need residency. Let's just say 5 years of residency, making only $30,000 a year, all to make $200,000 a year as a physician, working 60 hours a week and having to spend all your money on student loan repayments, other debt repayments, and malpractice insurance. Now pause. All of this may sound realistic. It may also feel realistic, but the reality is it is not based on logic. The numbers I presented were random and heavily skewed towards not becoming a doctor, meaning you may have had doubt about becoming a doctor, then added calculations or reasons against becoming a doctor to arrive at the conclusion of not becoming a doctor. Now, you may wonder how many people actually do this or think this way. And the answer is most people think this way most of the time. I know it's crazy, but your mind does this to protect you. Your mind lies to you to help you avoid experiencing a potential loss. What's also crazy about loss is that it's possible for you to feel and experience a future loss before it happens, even if it's unlikely to happen. Also, it's almost impossible for your mind to experience a future gain or pleasure from completing a task or accomplishing something. This is why we procrastinate. This is why we don't start businesses. This is why we don't run towards investment opportunities. Our mind is trying to help protect us, but also hold us back from opportunities. If you've ever had an idea to do something and chose not to do it, it's probably because of loss aversion bias. Deep down, you did not feel it was worth it to complete the required work. The way to avoid loss aversion bias is to use math and logic to arrive at accurate conclusions, which connects back to our previous question. Should I fund a bank on yourself type whole life policy, or should I just buy term and invest the rest in the stock market? Before we look at investments and products and how they work and what you could potentially earn, it's important to first ask, what do you want your money to do for you? What do you want to accomplish? Rather than looking at the investment vehicle as the goal, look at the investment vehicle as a tool to help you get to your overall goal. Here are some ways to identify your goals. Ask yourself, what do you care about? What is important for you in your life? What problems do you want to solve in the world? What types of investments do you want to avoid? What's an ideal rate of return for you? How did you arrive at this number? What does financial success look like to you? What do you need to get there? I recommend journaling these questions and answers frequently, at least once a week, to get extra clear on what you want and to remember why you want those things. During this meeting with my client, he mentioned he wanted to accumulate as much as possible over the next 30 years and wanted to choose an investment option that would provide the most benefit, which to him meant the most amount of money. Many people have this general goal, but again, it's important to break the numbers down and really dive in to see if we're able to accomplish this goal and to consider the risks. The client mentioned he wanted to save about $3,000 per month or $36,000 per year over the next 30 years, which is equal to about 20% of his total gross income annually. 20% of income is typically seen as a larger number to save every year, considering the cost of living. The client, however, feels comfortable. And in my opinion, this seemed accomplishable based on his income, expenses, and goals. So this gives us $36,000 to invest over 30 years. In this scenario, we're starting with contributions first to see what we can get to in 30 years. Sometimes we would do this in reverse, where we would establish a dollar amount as a goal in the future. We don't always have to start with contributions, but this gives us a good starting point in this financial plan. Here are some of our options. Option one, we can compare $600,000 in term life insurance, which is equal to about $1,616 per year based on this client's age and assuming a standard rating. We can then invest $34,384 per year into a diversified stock account consisting of long-term stocks that pay qualified dividends managed by a financial advisor. For this, we'll project an 8% return, which is usually seen as an average return based on data provided by the S&P 500, which tracks the 500 largest publicly traded companies. Option two, we can save $36,000 directly into a bank on yourself type whole life policy for 30 years. Or option three, we can save $36,000 in a policy and then take out loans every year to invest in the stock market. So option three is a combination of option one and option two. Now, again, the client's goals are to grow the most amount of money over the next 30 years. So ideally, we want to choose the option that may provide the most growth. But here's a twist. And this is where a lot of financial advisors and clients get this wrong. We have to consider fees and taxes. In all three options, the client is allocating $36,000 per year for 30 years. With option one, if we invest $34,384 into a diversified account at 8% over 30 years, minus a 1% fee every year, this is the average investment advisory fee according to USA Today, you would have $3.2 million after fees. In terms of taxes, let's assume 20% will be needed for taxes because most of these stocks will consist of long-term capital gains and qualified dividends that were reinvested. This means you'll be left with $2.6 million. I have all of these numbers in a spreadsheet. I can send it to you if you reach out to me. The link is in the show notes below. So if everything goes to plan with option one, we'll have $2.6 million after taxes and fees in 30 years, along with $600,000 in life insurance that will expire at the end of 30 years. So actually zero in life insurance, but $2.6 million net of fees and taxes in a brokerage account. Now let's say option two, we save $36,000 into a bank on yourself policy. At year 30, we'll have $1.94 million. Now let's pause for a second. Even though option two is less than option one, 1.94 million compared to almost 2.6 million, that's not bad at all for zero risk, zero taxes, and zero investment advisory fees. Also, we'll have $3 million in life insurance with option two. Now, the objective of this podcast is to ask, what if we did both? We save in a bank on yourself policy and invest in the market in the same types of stocks. How much would we have? Again, if you reach out to me, I'll send you the spreadsheet. Year 30, after 30 years of paying $36,000 per year, the client will have $1.9 million in the brokerage account after a 1% fee and paying 20% in taxes. We'll have an outstanding life insurance loan of $1.8 million, assuming an interest rate of 6.2% and no repayments. Let's say the client takes out a withdrawal from the brokerage account of $1.79 million to repay the loan. Now the client has cash value of $1.94 million. Remember, there weren't any interruptions in the growth, and now we, after a 1% fee and paying 20% in taxes, he'll have an outstanding life insurance loan in the amount of $1.759 million, assuming an interest rate of 6.2% and no repayments. Let's say the client takes out a withdrawal from the brokerage account of $1.79 million to repay the loan. Now the client has cash value of $1.94 million. Remember, there weren't any interruptions in the growth, and now he has the full amount because the loan has been paid off. He also has $144,000 in the brokerage account. And since this is a life insurance policy, he has $3 million in death benefit. So $1.94 million in cash value, $3 million in death benefit, and $144,000 in the brokerage account. All of this would be income tax free. So based on math and logic, by adding funds into a bank on yourself policy and using this to fund investments, the client would have more than just investing in the stock market directly. As you can see from math, you don't have to choose between an investment or bank on yourself. You could do both. You could do both for a good reason, which is to have more money left at the end of your journey. Aside from improving market returns using a bank on yourself policy, you can also grow an account alongside your investments that is not impacted by market conditions, grows tax-free, and you have life insurance. Also, in many states, the cash and life insurance are protected from creditors. Check with your attorney about that. How can we help you with all of this? For one, the obvious. We can help you structure a high early cash value life insurance policy to use for investments. And as a CFP professional, I can help you look at different investments that align with your investment goals. It's important to remember that not all life insurance policies can do what we mentioned, and that you want to work with a trusted and competent advisor who knows how to structure policies like this and who understands where you're going to invest your borrowed funds and the long-term impact. You can reach out to us by going to thinkinglikeabank.com, then schedule a call, then choosing intro call. I'm looking forward to hearing from you and helping you reach your financial goals.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's Fin, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.